Okay. FY19 was a steady year for DLF, especially considering the pain in the real estate sector. What were the key highlights given the backdrop of the QIP fundraising as well?
I'd say that the three big developments over the last fiscal have been clearly a very decisive deleveraging and balance sheet restructuring, which poises us very nicely for future. B, getting a partner like GIC on board, and which can hopefully, make our rental space and our rental platform, which already is possibly the best in India, to even greater heights. And C, clearly our sales engine, which had a couple of lukewarm years before that, across the last 15 months or so, has begun sort of chugging along very nicely. We had a very successful product in Gurgaon called Crest. Our golf course luxury product Camellias is doing very well. And we have begun seeing traction across the country in the various developments. So clearly, getting the sales engine up to about 2,400 crores of sales last year from a number which was less than half of it the previous year was also a big development. So really, these three pieces are the basic building blocks of last year as we now embark into 1920 with a reasonably clear strategy both on the rental space and on the developmental space in terms of what we want to do.
So walk us through the debt status of a company post the rental arm and the QIP issue, and how much is there in DLF 2.0 now?
As of March 31st, our net debt number was about 4,400 odd crores, and we had about 800 odd crores towards land commitments. So I mean, a total liability just north of 5,000 crores. We expect that with the residual promoter infusion that will happen now, this number of the total net debt should be a number somewhere around 2,000 crores by March 2020. And just to put the perspective of that number, is that our EBITDA to interest ratio next year should almost be like 10:1, down from 1:1, which used to be the case 5-6 years back. So I mean, it's been a dramatic, deleveraging of the balance sheet. And obviously, in the 2,000 crore number, we'll try to get down to zero across the next few quarters. But honestly, that number has become almost meaningless now.
Right. Ashok, also, given the strong response to the Embassy REIT, any plans of you doing a REIT listing in the coming months, say with GIC perhaps?
So we are delighted on the response that the Embassy REITs got, because honestly, it clearly sets up a big platform, not only for us, but for all rental asset players in the future. As far as we are concerned, the GIC private equity investment happened in December 2017. So honestly, it's pretty early for us to be actually thinking of a REIT. But I'm sure at some stage in the future, GIC and us could decide on, on a potential REIT monetization. But it's not happening in the immediate short or medium term.
Right. The DLF Cyber City developers' rental targets have also been upped and is now, I guess, targeting about 20% CAGR rent growth till FY22. How do you think this is going to change the operating ratio and the earnings trajectory for you guys?
So honestly, we believe that in the next 5-year horizon, both our development and our rental arms should be growing in the late teens to almost 20% CAGR. As far as the rental arm specifically is concerned, we are predicting that our total rentals, which were in the late 20s right now, will move to about 4,700 crores in a 3-year timeline. It's a combination of really three things. One is just the organic rental growth, both on account of the annual escalations that happen and the regular mark-to-markets that happen, which combined is almost a 8% annualized growth. B is the rental accretion on account of the assets that we are transferring from DLF into this platform. And C, we are, in this fiscal 1920, we should be commissioning one big asset in Gurgaon and one big asset in Chennai. And we are commencing construction of about 3 million square feet in Gurgaon this year, and almost, a similar number in Chennai and a smaller number in Hyderabad, all of which should be coming to fruition in the next 3 years. So actually this, in 3 years' time, we expect that the rental number hopefully by the time we exit 22, the run rate should be running at about 4,700 crores.
Sure. Mr. Tyagi, is DLF also getting back to launching new projects after a long hiatus that it's seen of over 5 years?
We are clearly launching new commercial projects, as I mentioned, both in Gurgaon, Chennai and Hyderabad. As far as the residential projects are concerned, we have an inventory of about 11,000 odd crores, as our last presentation must have shown you, which we expect to liquidate across the next 3 to 3.5 years. However, we have commenced construction on our next big project, again in partnership with GIC in central Delhi. That has commenced, and we should be commencing construction of possibly one more commercial and one residential apartment in the next 3 to 4 quarters. However, even though we will be commencing and launching projects for construction, we will be not bringing them to the market till a late stage of construction has been achieved, because A, we have the inventory to be able to handle the sale for the next 3 odd years, and B, we just believe that both in in the light of the regulatory environment as well as from a customer uncertainty standpoint, it's best to bring a product to a customer once it's almost nearing completion, so that the customer almost knows exactly what he or she is buying, what is actually buying on a piece of brochure.
Okay, and what about the impact of the funding crunch that's being seen across the developer space? Still not seeing much relief in the funding environment. Are realty prices headed lower?
So as far as we as a company is concerned, as far as corporate borrower or DLF is concerned, honestly at these debt levels, obviously there's no need for accessing any debts, and if there are a number of lenders who are more than willing to do. In fact, on the rental side, we had 2 refinancings of the erstwhile CMBS, which happened very smoothly, honestly at rates which were significantly lower than the CMBS paper was. However, I think in each geography in India now, you will have 2 sets of developers. A set of developers who sort of, have emerged from this crisis, for whom funding will be available, and honestly even for whose customers the home loan market should by and large be available from the bigger banks and the bigger HFCs. However, I mean, there's no denying the fact that there is a set of stressed developers who possibly were relying more on the HFCs or some of the small NBFCs for funding. And given the entire crisis in that sector, I think the funding access to those has been curtailed, and I think would continue to be tightened. It's some of those developers who are also saddled with a large chunk of WIP or unfinished or extremely early stage inventories, and I think that sector would continue to have stress. So I think in each of the geographies, be it Delhi, Mumbai, Bangalore, I think you would have maybe 2 or 3 developers who sort of have handled their issues and are poised to grow, but a larger chunk of small to middle set developers who will continue to face the crisis that you were alluding to. And I think eventually there will be some sort of shakeout in the sector, at least in that segment.
What is your assessment of the stress in the overall real estate sector? Because demand is weak, we all know that.
So the demand is clearly again segmented. The demand for ready inventory or finished products or products which are almost finishing, I think has strengthened. Our own sales, as I mentioned in the last year, doubled over the previous year, and we expect a strong trend to continue this year as well. Also in NCR and in some other geographies, we have seen some very encouraging sales numbers being reported by some developers, not all, but some developers. So clearly it is not that weak demand is a secular issue. There are some developers who, because of their product baskets, because of the readiness of the inventory and whatever, because of their credibility, location, have been able to buck that trend. However, at times the inventory and the so-called weak demand piece gets accentuated by the huge chunk of unfinished inventory that is there in large parts of the geography, including in various segments of NCR. And I think that most of that actually belongs to the stressed developers. And frankly, the line of sight to completion of those, is extremely uncertain. And as you know, that even the Honorable Supreme Court, NCLT, everybody is trying to work on those pieces, but yet there haven't been any solutions. So again, I think for certain developments and certain developers, the demand is returning, but for a large chunk of the mid-range projects and the stressed developers, I think because of both micro and macro reasons, the demand continues to be a challenge.
So tell us, how worrying is the NBFC issue and its cascading effect on housing sales? How is the retail end of the demand, given 70% of the sales actually happen through the funding?
So in all fairness, first at least about us, in a large chunk of our home financing with the customers is done through the bigger players like ICICI, HDFC, SBI, who obviously have not been impacted. However, it's a fair thing to say that a large part of the market where the home buyers were resorting to borrowing not from the bigger players but from the other HFCs, and given what one reads in the papers about that sector, I think there clearly would be some degree of squeezing of fresh disbursals. And frankly, unless the bigger players and the banks step in to fill that void, this could lead to a tightening of the housing market, going into the immediate future, which could have a downward impact on demand. As far as we are concerned, hopefully the bigger players, who anyway were about 90% of our entire home borrowers market, I think that so really it doesn't impact us, and I'm sure a large number of other more established players. But again, to your point, yes, a part of the sector will get impacted by the HFC issue.
Okay, so something that your shareholders would want to know, what's the kind of guidance that you're setting out for FY20?
On a broad basis, our rental portfolio, which is Cyber City, should end FY20 with a rental run rate of almost running into 3,400-3,500 crores, up from to the 27-28 this year. Our residential sales, which were about, residential means the development company sales, which are about 2,400 crores this year, we expect that to grow to about 2,750 next year. And as I mentioned, that our net debt number, which was about 4,500 crores as we ended last year, should be a number around 2,200 crores by the end of March 20. That profit guidance we generally don't give, so that I'll hesitate from doing that. But again, if you were to see our presentation for the last quarter, the total embedded profits in our inventory sold and unsold is about 11,000 crores, and that EBITDA which will get unlocked in the next 4 odd years.
Mr. Tyagi, your industry peer Godrej Properties has been acquiring distressed assets. Are you also looking at such opportunities? Any attractive targets on your radar or any new geographies?
Short answer to the first part of the question is no. And the reason for that is frankly because we believe that we have a lot of development potential embedded with us already in terms of land banks and the FSI potentials that we have, both on the rental side and on the developmental side. Like as an example, on the rental side, we currently run about 30 million odd square feet of leasing, 30 million plus, and we have a development potential of almost another 30 million square feet within us. So we don't have a compelling need to go out and say acquire something at a slightly higher cap rate and operate in that cap rate play. Same for residential. As far as your second question is concerned of other geographies, I think on the residential side, clearly we currently stay focused on what we are doing in the geographies we are in, primarily NCR and some pockets elsewhere. On the commercial side, we clearly are alive to the fact that at some stage we might look at the 2 big geographies where we are not present, which is Mumbai and Bengaluru. But again, that will happen in conjunction with GIC at a future date. Right now, we believe that even in that joint venture with GIC, we have so much development potential to be done at our end between NCR, Chennai and Hyderabad that right now I don't think we have either the bandwidth or the inclination to look at any inorganic sort of acquisitions.
Thank you so much for joining us this morning, Mr. Tyagi, and sharing your outlook with us. It's good to have you with us on ET Now.